Hi, welcome to Financial Management, second lesson. My name is Mr. Anthony Moremi, and I'm the lecturer who will be taking you through financial accounting, or rather, in your case, Introduction to Accounting, which is the same thing. So, in the first lesson, we shall look at the first topic of financial accounting, that is Introduction to Accounting. So under this topic, we shall look at the various definitions of accounting. We shall define bookkeeping, which is a term that is quite similar to financial accounting. We shall look at the functions and objectives of accounting. We shall look at the users of accounting information. And we shall also look at the balance sheet equation and various other introductory items in accounting. So to begin, we look at the accounting definition, and we shall see, as you can see there, we have two definitions of accounting. One, accounting is defined as a process of recording, classifying, and summarizing in a significant manner, and in terms of money, transactions, and events, which are in part at least of a financial character, and interpreting the result thereof. We also have a second definition of accounting, which is defined as the analysis, classification, and recording of financial transactions and the ascertainment of how such transactions affect the financial performance and position of a business. So by looking at those two definitions of accounting, you notice that there are some key terms in that definition. The key terms there have been underlined, like we have recording, we have classifying, we have summarizing in that definition. And we also have in the second definition, we have the analysis, the classification, and the recording of business transactions. Yeah. So there are some key terms that should not miss in a proper definition of accounting. Yeah. So we have it's a process of recording, is a process of classifying, the process of summarizing, of business transactions, and reporting the impact of these transactions to a business. So when called upon to define what accounting is, you don't have to give a crammed definition. All you need to do is to note that there are some key definitions, the key terms. And these key terms are all about the activities of accounting. Yeah, that involve recording of business transactions, that involve classifying of these transactions, and in this case in accounting, you classify into various accounts, like we have capital account, debtors account, and so on. And then we analyze, we classify into accounts, and then we analyze. To analyze is to be able to get to know the impact of the transactions on the financial performance and position of a business. So we analyze the impact of a transaction on the performance and financial position of a business, and then we do the summaries, and by summarizing we come up with reports, yeah, on the impact of business transactions on its profitability and on its on its financial position as at a given date. So down here we have the elements of an accounting definition. So I've said that you don't have to cram the definition of accounting. All you need to know is to note the key terms, of which these key terms are the activities, the normal activities of an accounting process. Yeah, the accounting is a process, and being that it's a process, we can say that accounting is a series of activities. Yeah, we can define a process as a series of activities that are all geared towards achieving a given objective. So the same case with accounting. It's a series of activities that are geared towards the determination of the impact of business transactions on the performance and financial position of a business. So the essential elements of an accounting definition are: one, recording of accounting data, or we can say recording of business transactions. Yeah. So one of the key terms in an accounting definition is the process of recording transactions. So we record these transactions in the books of accounts. That is, we have the journal, and you also have the ledger, where business transactions are recorded. So one key element of accounting is recording business transactions as and when they take place. So all the transactions of a business need to be recorded by the accountant. The second element of a proper accounting definition is classifying and summarizing. Yeah. So data recorded in the books need to be classified in various accounts. So we classify the accounts into various accounts. Yeah. Such accounts such as assets accounts, liabilities accounts, expenses accounts, revenues accounts, and capital accounts. So that involves classifying. Yeah. So we classify, so we have various transactions, numerous transactions. These transactions need to be classified. So that's another key element of an accounting definition. And then we have summarizing, which is another key element of an accounting definition. So summarizing facilitates the determination of profits and losses. Yeah. So we have a lot of many transactions, yeah, taking place in a given period of time. Yeah. So it would make a lot of sense if these many transactions can be summarized, yeah, in a small report that can be given to the various stakeholders of the business, yeah, to give a report to communicate the impact of the numerous transactions on the financial performance and on the financial position of a business, so that we're able to tell that the business has made this much in terms of profit or losses. So summarizing. So classifying and summarizing are key elements in an accounting definition. The other key element is communicating information. Yeah. So the reports derived from classifying and summarizing business transactions is communicated to the various interested persons. Yeah, the stakeholders of the business, or in this case, we refer to them as the users of financial information. Yeah. So people like the owners of the business, the suppliers of the business, the lenders, the banks, the customers, and the general public. They are all in need of the financial information of a business. So, and accounting comes in to provide that information. Information on profitability and information on the financial position of the business. And then another key element of a financial accounting definition is business transactions. Yeah, I think I've talked repeatedly about accounting being the process of recording business transactions. Yeah, the process of recording transactions. Transactions is a key element in accounting. Yeah, a transaction is defined as an activity which takes place for a business reason. So those activities that take place in the business, those activities, we refer to them here as transactions, need to be recorded that on this and this date we sold this item, this and this date we bought this item, this and this date we paid for electricity, this and this date we fired some staff, and so on. So these activities ought to be recorded in the books of accounts and in the journal. So accounting has this role of recording business transactions. One thing to note about business transactions is that we have financial transactions and non-financial transactions. Accounting only records financial transactions. Financial transactions are those which involve money, yeah, which can be quantified in monetary terms. A financial transaction is that which can be quantified in monetary terms. You can actually attach the value of money to this activity. Yeah. So financial transactions which can be quantified in monetary terms is the only transaction that can be recorded in the books of accounts by the accountant. Non-financial transactions cannot be recorded in the books of accounts. A good example of a non-financial transaction or activity is hiring of a new employee. So you've just employed someone, no money has been spent. Yeah, so that's not an activity that should be recorded by an accountant. This is an activity that can be recorded by the human resource manager. It's a human resource manager that deals with the hiring and firing of employees. So hiring of employees doesn't involve any monetary claim as such. Uh, as such, it needs not to be recorded by an accountant. It can be recorded by the human resource manager. So we only record those transactions that are of a financial character, yeah, that involve money. Yeah. So when the managers have a board meeting, no money is spent, no need to record that activity because there's no money involved. That is in accounting. So in accounting, we only record those transactions that are of a financial nature. So it's important to note that transactions to be recorded in the books of accounts, they have to be they have to be of a financial character. So activities such as hiring of a new employee or conducting a lecture that do not involve the transfer of money are thus not recorded in accounting. They can be recorded by another professional. Like I've said, the human resource manager will record the hiring of a new employee. Another key term that may have been left out in this note is the analysis. Yeah, analysis of the impact of business transactions on the financial performance and position of the business. So as an accountant, you need to be able to tell that these numerous transactions affected the profitability of the business this way. Yeah, because we had many sales, the profits of the business have improved. Yeah, so the analysis is also another key element of an accounting definition. The analysis of the impact of a business's transactions on its financial position and the financial performance of the business. So I hope you're all together. So next we look at another definition, that is bookkeeping. So bookkeeping is defined as the art of recording business transactions in a systematic manner. It is a process of recording in the books of accounts all those business transactions that result in the transfer of money or money's worth. Yeah. So bookkeeping is that. So what to note about bookkeeping is that bookkeeping is a part of accounting. That part of accounting that merely deals with recording of business transactions. Yeah. So bookkeeping merely deals with recording of business transactions. Just that. Kuandika tu, kurecord. So the transaction takes place, they note it down in the books of accounts. They put it in the ledger, they prepare the source documents like the invoices, the the cash sales and receipts and so on. So that's the work of a bookkeeper, merely to record. The bookkeeper doesn't summarize, the bookkeeper doesn't classify, the bookkeeper doesn't report the impact of transactions on the financial performance and position of the business. So I can give a good example of a bookkeeper in an organization. So um, in many organizations, we have a hierarchy. Yeah, we have the person at the top there and the person at the bottom in that business. So the top you find the accountant, or in most cases they are known as the financial managers. That's the accountant. His job is to record business transactions, classify, summarize, and communicate the effect of these transactions on the financial performance and position of the business. And then at the bottom there you have the accounts clerks, whose job is merely to record. Yeah, they don't do the communication. The communication is made at the top to the public. It's at the top. Yeah, it's the CEO, it's the accountant who communicates the profits of the business. But down there we have the accounts clerks, whose job is merely to record business transactions in the books of accounts. So that is bookkeeping. So bookkeeping is for the clerks, accounting is for the persons at the senior level. Yeah, accounting is for the persons at the senior level, whose job is to do all those activities in accounting: recording, classifying, summarizing, and reporting. Whereas at the bottom, we have the accounts clerks, whose job is merely to record transactions in the books of accounts. So therefore, here we have accounting versus bookkeeping. So you can see that accounting has a wider scope than bookkeeping in every organization. So while accountants record, classify, and summarize business transactions, bookkeepers are merely involved in recording of business transactions. Yeah. So bookkeepers, yeah, kazi yao ni data entry. The person who key that data into the system or in the books of accounts. So functions of accounting, or rather the objectives of accounting. So we have several, but in our case, we shall look at a few of them. So one is ascertainment of profit and loss. Yeah. So most businesses are established to make a profit for the owner of the business. So as such, the owner of the business needs to know what profit has been made. And for him to know the profit, proper books of accounts have to be kept. The trading on the profit and loss account, or rather the income statement, has to be properly prepared so as to give the net profit and the gross profit of the business for a particular period of time. And accounting serves that role very well. So for the accurate and complete recording of business transaction, it is uh, uh, accounting and complete recording of all business transactions is essential in the determination of profit and losses. So accounting will serve that purpose very well. It's accounting in that organization that is able to tell whether the business has made a profit or a loss, because it's the accountants who prepare the profit and loss account, which shows the profit or loss that the business has made. Then number two objective of accounting is to facilitate credit transactions. So accounting records facilitate credit transactions because these records will determine the amounts due to creditors and amounts due from debtors. It's not done here, but due. The amount due from debtors. Yeah. So accounting will facilitate credit transactions. Yeah. It's only when accounting records have been properly kept that you're able to tell that this is a risky business or this is a credit-worthy business. Yeah. Because looking at its balance sheet, this business has not borrowed, has not overborrowed. Yeah, the business is stable. It has enough assets to pay these liabilities. So as such, you can facilitate credit. We can extend credit to this business because it has sufficient assets to pay its current credits or debts. So accounting will serve this purpose very well. It will help the bank or the lender to determine the credit position of the business so as to be able to extend credit to this business. Then number three, we have accurate assessment of tax. So accounting facilitates the accurate assessment of tax by availing records which show the profit or loss that the business has made or incurred. So without a proper accounting system, the business will not be in a position to pay the correct amount of tax. The business may pay may overpay taxes or may underpay taxes. If it overpays taxes, that is a loss to the business because it's losing too much money to tax. On the other hand, if it underpays the taxes, this may come with some fines. Yeah, KRA is known to fine the taxpayers who have not paid tax properly. So to avoid these problems of paying tax or losing money to tax, then you need to have a proper accounting system that gives the accurate figure for paying tax. And as such, you need a proper accounting system, which will give us the accurate figure of profit in order to repay the right amount of profit. We also need a proper accounting system to help us pay in paying taxes like VAT. Yeah, so we pay VAT on our sales and purchases. If our sales and purchases have not been properly recorded, then we just be guessing how much VAT we are going to pay to the government. In which case we may overpay or underpay, which in both cases is a problem to the business. Either way, we overpay, we are losing money to the government unnecessarily. We underpay, we are fined. We are in legal problems with the government, and no one wants to be in a legal problem with the government. So it's important to have a proper accounting system so as to pay the correct amount of tax. And then the other function or objective of accounting is for the evaluation of assets and liabilities. So through a balance sheet, details relating to assets and liabilities are shown. So this shows the financial position of the enterprise, and it can be used as a security for a loan. Yeah. So accounting serves this purpose very well. Through the balance sheet, it's able to show the assets and liabilities of the business. So you're able to tell that this business has this amount, this worth of assets. It owes this much in liabilities, like that. So evaluation of assets and liabilities is also another objective of accounting. And then another function or objective of accounting is a tool for control. Yeah. So I know you guys are doing principles of management, and you guys will be managers in future. So control is one of the functions of a manager. And what does control mean? Control means to realign yourself or the organization towards your objectives. Yeah. So the question is, are you meeting the objectives that you intend to achieve? Yeah. So in that case, you are doing a control. It's like at a personal level for you as a student. I know you have coronavirus, so learning is not normal. But assuming when there was no corona and learning was physical, you are here in campus and you're making friends. So you come here as a very innocent young lady, young man, yeah, who has a vision with him, who wants to graduate maybe with a first class, go get a good job. Yeah, so you come here very innocent and you tend to join a funny group of friends who may mislead you. Yeah, so you find yourself swaying from the original objective. So you're away from the academics. Now you're doing some. Yeah, so you find yourself losing track. Yeah, so you find yourself not performing well in class. So at that point, you you call yourself into a small meeting and evaluate your performance and what has led to this performance if it's a negative performance. So then you take some corrective action, yeah, to help you improve in academic performance, to improve in your whole self, that is. So at that point you are doing some control, yeah. So you need to control your activities, you need to control your expenditure in order for you to achieve an objective. That's at a personal level. That's something that normally everybody does. So the same case for organization, yeah, they all need to do some control, yeah. So to reevaluate themselves, to determine whether they are on the right path of achieving their objectives or not. If they are not on the right path, do some corrective activity to help them revert to the path of, say, profitability. So accounting will facilitate control in an organization, because if an organization is making losses, then we need to know where the losses are coming from, and the financial statements can show that. So it can show that our expenses were too much, so we need to control our expenses. Yeah. So a proper and accurate accounting system will be helpful in controlling unnecessary expenditure and misappropriation of funds. Yeah. So as to help the organization still achieve its objective of making profit. So accounting serves that role very well. That is the role of tool for control. Then accounting can also be used as a base for further planning. Yeah. So as managers, I know you are educators, but you'll be managers, God willing. So another function of a manager is planning, to set objectives to achieve. Yeah. So by the end of the year, I want to have achieved this. Yeah. So organizations also have goals to achieve. Businesses will have that goal of profit maximization. We want to maximize our profits. Yeah. So how do we set these goals of profitability? Yeah. Well, for us to set a profitability a goal, one thing we learn in management is that a goal has to be SMART. SMART is an acronym. Yeah. Now the goal has to be specific, measurable, attributable, realistic, and time bound. So that is an acronym for SMART. Yeah. So to make SMART goals, a goal that is realistic, we need to come from a realistic background. That if this is a business that has been operating, these are the profits that it has been making, and this is the most realistic profit that you can achieve. With this investment, with this, if we bring in resources of this, to the business, new resources, we add to the current resources, we'll be able to improve our profits from here to this much. So accounting will give us that realistic ground of us being able to make a realistic goal, of us being able to make a measurable goal of profit. You cannot be a small organization making profit of say 100,000 shillings and then you just wake up one day and you assume that you make a profit of 1,000,000 shillings unless something has been made, unless an investment has been made. So you need to be realistic. Accounting gives us that sufficient information to help us in making goals. So accounting can provide sufficient data relating to sales, profits, investments to facilitate making decisions about future programs. So that, students, those are some of the objectives of accounting. So I've not exhausted all the objectives of accounting. So yeah, so any relevant objective will apply. So we move forward to the users of accounting information. The users of accounting information are basically the persons interested in the affairs of the business. They are also referred to as the stakeholders of the business. Persons whose activities may be affected by the activities of the business, or person whose activities may affect the affairs of the business. Yeah. So examples of these persons, of the users of financial information, we have is the owners or the entrepreneurs, also known as the shareholders of the business. They have invested capital into the business. They have invested in the business. Examples of such owners include the sole traders, that is the entrepreneur. We have the partners in a partnership. We have shareholders in a company. So information in accounting will help them to assess how the managers of the business are performing and whether the business is profitable or not, and whether to make drawings or put in additional profit. So the owners are mainly really interested in the profitability of the business. So they established this business to make a profit, to earn a return for themselves. So they want to know whether this business is making a profit or loss. As such, they need this information. They need the profit and loss